Hello, I'm Raul Elizalde with a quick take on the markets. A big recent story in the media was that inflows into money market funds during the first week of July were at their highest level in 18 months. The Financial Times titled the story "Big Inflows into Money Market Funds," and it went on to say that this happened, and I quote, amid fears that a double-dip recession could send financial markets tumbling. It also said that investors are worried about the risk of another slide in share prices, and that the move into money markets is all about capital preservation. In other words, the media treated this news as a big turn in sentiment, as if all of a sudden there is a big rush into money market funds in search of safety. This is not quite accurate, because investors are not going into money market funds. In fact, investors have taken more than $1 trillion from money market funds since the beginning of 2009. Yes, there was a large inflow in early July, but this barely made a dent on the relentless exodus of money from cash funds that offer no yield. Monetary policy brought down short interest rates to practically zero, and investors responded by making a large shift out of money markets and into longer maturities. The impact of this wall of money going into U.S. Treasury bonds has been undeniable. Interest rates for longer-term debt fell to exceedingly low levels, even as critics bashed U.S. fiscal policy and have predicted for quite a while that fiscal deterioration would send interest rates soaring. This simply has not happened, and those who thought that U.S. bonds would go down made a very bad call. Long-term bonds went up very strongly, especially in the second quarter. Now, looking at where money went in the last year or two, we not only see clearly that it left money markets and went into bonds, but also that investors actually took money out of U.S. equity mutual funds and ETFs, even as stocks had one of their best 12-month periods in history. There was some money going into non-U.S. stocks, but bonds got virtually all the money that left money market funds. So the mystery is why, with so little money going into equities, they managed to stage such a strong rally in 2009. The Federal Reserve flow of funds tables that describe the ownership of corporate equities shed little light to explain this. Demand seems to have been consistently distributed and little changed among different ownership categories throughout 2009 and 2010. Unlike bonds, where demand was crucial to lift prices, stocks seem to have gone up only on expectations. The question now for an investment manager like me is whether this state of affairs is sustainable. Well, the answer seems to be yes. Money won't flow back into money market funds unless interest rates go up. But as long as signs of inflation remain non-existent, the Fed is unlikely to change its policy of very low rates. Investors could run away from bonds if people start to think that the U.S. will have trouble repaying its debt, but this seems also unlikely in the near future. For the time being, it seems, the money river will continue to flow into bonds. Foreign holders who own about half of all U.S. Treasury debt are unlikely to dump it as long as the U.S. dollar doesn't weaken significantly, especially against the euro. And there seems to be little reason to see a change of sentiment there, as the austerity pledge that Europeans just made will not create much internal growth. And the main domestic buyers of U.S. Treasuries, which are households and local and state governments, don't seem ready to reduce their holdings either, as long as foreigners don't bail out and that the Fed doesn't change policy. Everything suggests then that the breakdown of asset demand will not change much in the next few months. Investors don't seem to find any compelling reason to stop buying bonds or to commit much money to equities, leaving stocks to go up on expectations and hopes alone. For more information, please visit us at www.pathfinancial.net. I'm Raul Elizalde. Thanks for watching.